Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Today, we're going to be talking about good old Tether, as I believe it is the emergent global central bank. Best business model in the world, will be the most powerful company in the world, probably. Strategy will be there, Tether will be there. Those are the top two in my opinion. So why Tether, do you ask? Well, I want you to think of a privately run balance sheet that already rivals the monetary base of a small OECD nation that's printing more profit margin than Wall Street banks and settles value across the planet at nearly the speed of light. That entity is not the Federal Reserve, it is Tether. Today, there are roughly $177 billion of USDT in circulation, all spendable within a few taps on any phone with a Tron or Ethereum wallet. Each token is turning over very quickly. The blockchain data shows more than $35 billion worth of USDT changes hands every single day. That is a figure that puts Tether in the same league as the largest card networks. And the float on the flood of digital dollars is immensely profitable. By parking their reserves in very short-term treasuries and reverse repo, Tether earned $5.7 billion in net income in just the first half of 2025. That profit stream then refuels issuance and bankrolls expansion without external capital. I believe that Tether is the most profitable company per employee in the entire world, thanks to this incredible business model. Comparing this to Visa, for example, Visa processes about $16 trillion in annual volume, roughly $44 billion a day. Tether is already hovering near that pace, yet it carries zero merchant acquirer friction and no weekend downtime. Fedwire moves larger gross value, yet it still closes nightly and on holidays, so in the settlement spread arms race, Tether is going to catch the legacy rails from below. Now, talking about the strategic framing, Adam, why does this all matter? Because whoever settles the marginal global transaction sets the default unit of account. If the fastest rail denominates value in USDT, then Tether becomes the de facto central bank for all of digital commerce. Its reserve mix, which are treasuries today, they're growing Bitcoin tomorrow, that gives it discretionary power over collateral that all the nation states are going to envy. I hope that this slide establishes the what, that Tether is already a profit-printing, high-velocity monetary base, but next I want to dissect the composition of that base and why its muscle on the asset side continues to expand. A special thanks to Horizon for sponsoring this video. Horizon helps you buy Bitcoin using your home equity without debt, monthly payments, or term limits. The Bitcoin is fully yours to custody however you would like with no risk of forced liquidation. They're linked down in the video description below. I'll talk more about them at the end of the video. Time to talk about the balance sheet muscle, folks. Remember this: the credibility of any monetary issuer rests on its reserves. So let's walk through why Tether's balance sheet already looks like a small country central bank, only with higher liquidity and stronger risk controls. Tether owns about $127 billion in short-term US treasuries. At that side, it stands alongside Norway's sovereign wealth fund and sits ahead of nations such as the United Arab Emirates in the league table of treasury holders. The market now treats Tether as a consistent buyer of front-end government debt, not a fringe crypto player anymore. Average maturity across all of those treasury notes is literally under 90 days. This keeps interest rate risk negligible and ensures that principal is always rolling back into cash, ready to meet redemptions within a single business quarter. In practice, most USDT redemptions settle within hours, so liquidity coverage is comfortably over-engineered. At current front-end yields near 5%, the treasury book alone is spinning off well north of $6 billion in annual coupon income. That cash covers all of their operating costs, any share buybacks. It could leave a thick surplus to expand their mining operation, fund research and development, and then just add more Bitcoin to its reserves. There's diversification without duration creep. Beyond the treasuries, the reserves include reverse repo, investment-grade commercial paper, physically allocated gold, and over-collateralized secured loans to vetted counterparties. None of these buckets exceed a single-digit percentage slice, so no one asset failure can threaten the peg of Tether. There is a voluntary excess capital buffer, roughly $4 billion at last report, that creates creates a first loss layer that will further protect users of USDT. So the reality is, guys, that Tether is already operating with the prudence and the firepower of a full reserve central bank. The next slide, I want to show how the surplus from this incredible engine is quietly being converted into Bitcoin, setting the stage for the eventual collateral pivot. And this is where the story starts to get a little spicy. Since January 2024, Tether has quietly transformed from a dollar-only reserve manager into one of Bitcoin's biggest whales. They started last year with 66,000 Bitcoin on the books. By March 31st of this year, that figure had surged to 100,521. And on September 30th, literally over a week ago, they have dropped another 8,889 coins with a $1 billion buy order, lifting the stack to just over 109,000 BTC, which is good for a top 10 spot among all corporates worldwide. More than a top 10, that's for sure. That's number 2. And that pace just matters. In only 21 months, Tether absorbed 2/3 as many coins as MicroStrategy bought in its first 3 years. But they did it entirely with internally generated cash flow and not leverage. At the current coupon run rate on their treasury book, they can afford to add 10 to 12,000 BTC every quarter without touching a single customer dollar. Now, if you layer in the second flywheel, the industrial scale mining. The CEO has publicly vowed that Tether will be the biggest Bitcoin miner on Earth by the end of 2025. The firm is already deploying billions into hydro-rich Latin America and modular flare gas sites. They're turning energy arbitrage into newly minted Bitcoin that flows straight into their reserves at the production cost. So the strategic logic here is very brutal and elegant. Each coupon payment or mined block becomes fresh BTC collateral, steadily hardening USDT's redemption floor. As that Bitcoin share rises from today's 4% toward 20% and beyond, market psychology flips. Traders stop worrying about dollar solvency, and then they start pricing USDT as a wrapped Satoshi. In other words, the more Bitcoin that Tether buys, the less it needs the dollar, and the closer it comes to wielding a monetary base harder than any sovereign currency on the planet. And here is the macro fuse that could ignite Tether's Bitcoin pivot. Washington is on track for a $1.9 trillion federal deficit this year, a sea of new treasuries that bloat supply faster than global savings can absorb. Even with record issuance, real yields are already softening. The 5-year TIPS rate slid from 1.9% in June to about 1.3% in the first week of October, which is signaling that buyers are demanding less inflation-adjusted return as the market anticipates future monetization. And while dollars debase, that means that stable coins moon. JP Morgan projects up to $1.4 trillion of incremental stablecoin-driven dollar demand by 2027, which is a 6-fold leap from today's $260 billion market. Yes, a 6-fold leap. That is according to JP Morgan and their projection for 2 years from now. And the lion's share of that flow lands in USDT, whose rail already processes more than $20 billion of value every single day, which is liquidity on par with Visa. But it's borderless and always on. If you put all of the pieces together, the deficits are swelling, the yields are compressing, and every fresh treasury bill Tether buys finances more USDT issuance. The resulting profit stream is being recycled into Bitcoin, inoculating reserves against the very debasement that fuels their growth. When a full reserve institution can print hard asset collateral faster than governments can print their liabilities, the center of monetary gravity starts to drift away from the Fed's balance sheet and toward a stateless ledger that clears in seconds. And that gravitational pull is the tailwind behind Tether's strategic reweighting toward Bitcoin. Everything up to now shows Tether's balance sheet swelling and its Bitcoin stack compounding. But you might ask, how does a dollar index token actually pivot to hard asset backing without breaking trust? Well, I want you to think of it as a 4-phase glide path. Phase 1 is collateral reweighting. As the coupon income comes in, as the mined coins flow in, Bitcoin climbs from roughly 4% of reserves toward a very visible double-digit share. Now, managements can codify a target band, perhaps 20 to 30%, then publish it inside their monthly attestation so markets can see the trajectory rather than guess it. A potential phase 2 could be an optional dual redemption. Tether could open a second redemption lane where large holders may choose dollars or an equal value in Bitcoin at an Oracle verified spot price. A few thousand BTC outflows prove that the pipes would work, which could then deepen the confidence, and arbitrage would keep the peg tight on both sides. Phase 3 would be a soft flip because once the Bitcoin slice pushes past 50%, the traders would stop and think, why quote USDT in cents when Bitcoin is the real floor? And that is the moment that it flips. The desks would then begin to market USDT directly against BTC pairs. Dollar liquidity remains, yet the mental unit of account has totally switched over to Bitcoin. The peg to the dollars then becomes a convenience feature rather than the existential anchor. And then the total end game, the death of the dollar, we would look at a hard peg with the reserves effectively 100% Bitcoin. Tether could then retire the dollar ledger entirely, leaving USDT as a bearer instrument that settles at the speed of light and is backed by the hardest collateral that humans have ever discovered, Bitcoin. At that moment, Tether is no longer riding on top of the dollar system anymore. It is running parallel to it, offering an instantly auditable, full reserve monetary base that is immune to fiat debasement and accessible in every jurisdiction with an internet connection. Any of these phases, they could have slight differences. Who knows exactly what will happen, but they can be rolled out gradually, governed by transparent thresholds and real-time proof of reserves if they want to, so that the market never faces a cliff edge. The brilliance here is that every coupon payment, every new block of mined Bitcoin, and every additional merchant integration makes the transaction more credible until one morning, the peg that matters is the one that's denominated in Satoshis rather than cents. Let's stack the two balance sheet behemoths side by side and ask a very simple question: whose money rail is actually harder, faster, and better capitalized? Start with the raw throughput. Fedwire, which is Wall Street's institutional spine, moves about $4.5 trillion a day. That is enormous, yet it still runs 5 times 12 and pauses on holidays. By contrast, the USDT rail already clears $20 to $25 billion a day. On-chain, 24/7, 365, settling final irreversible value every few seconds on the Ethereum blockchain. Measured in sheer transaction speed efficiency, dollars moved per second per node, Tether is catching a century-old wire network from below while never closing its doors. Next, if you just look at the leverage, we went over this briefly, but Tether operates as a full reserve one-to-one issuer. Every new token requires an identical increase in the liquid assets. The Fed, by contrast, we all know, carries $6.5 trillion in assets against just $45.7 billion of capital, roughly 140 times leverage. One mispriced duration shock shows up as hundreds of billions in mark-to-market losses, yet the Fed keeps printing because, well, it can. Tether's redemption discipline is enforced every minute by arbitrageurs with no lender of last resort safety net. Its peg survives only when the collateral is really there. The collateral quality just seals the comparison. The Fed holds 0 Bitcoin and is sitting on $1 trillion unrealized loss in long-duration bonds, while Tether has amassed over 109,000 Bitcoin, funded entirely from operating cash flow. And remember, every coupon payment, every time that they're going to mine Bitcoin when they're the most powerful Bitcoin miner on earth, it is going to go into the quasi-Bitcoin standard because it is just going to nudge the USDT closer and closer over time to that peg. The gravitational pull on the global settlement units are going to become irresistible. Put it all together, guys: faster settlement, 0 leverage, and a growing horde of digital gold. The Fed is still writing the statute, sure, but Tether is already winning the daily popularity contest where it counts, in the mempool, in the order book, and soon perhaps in the minds of merchants who will stop thinking in dollars at all. Time to talk about the catalysts and the headwinds. First, the tailwinds. In July, Congress passed the Guiding and Establishing National Innovations for U.S. Stablecoins Act, which is the Genius Act, which for the first time gives non-bank full reserve issuers a federal license and a clear playbook for disclosure, redemption, and capital buffers. So what happened overnight? The existential will they ban it question that dogged USDT for a decade plus totally faded, opening the door for pensions, corporates, and even US banks to hold or route dollars through Tether's rail. Second, the network effects have become a fortress mode, kind of like how how it has with Bitcoin or strategy. USDT commands 65 to 70% of all of the stablecoin supply, roughly $170 billion, and still clears the majority of on-chain volume. Liquidity begets liquidity. Each new listing or DeFi pool chooses the deepest order book, which then in turn deepens it further. And we all know that real-world payments are actually here, from Latin American retailers selling cell phones to Asia Pac e-commerce giants. Merchants are turning on USDT checkout because TRC20 fees are fractions of a cent and settlement is instant. Industry snapshots are already showing that USDT is already powering 30 to 35% of all crypto point-of-sale transactions in 2025, and dedicated provider studies call it the default stablecoin for business. Now the headwinds, transparency remains the soft belly. Quarterly attestations from BDO verify the excess reserves, $5+ billion at the last count, yet critics still hammer the absence of a full GAAP audit and opaque shareholder structure. A material disclosure misstep could dent confidence faster than any regulator ever could. Now, this is something I don't think a lot of people talk about often enough, but regulation kind of cuts both ways. While the Genius Act clarifies the rules, it also demands continuous reporting, money laundering controls, and for foreign issuers like Tether, a US chartered subsidiary. The planned USAT token to serve domestic clients. Yes, Bo Hines, congratulations on the gig. This could split liquidity across tickers, or missing a filing deadline could invite penalties or force redemptions. And there's always execution risk. Tether has to scale a global mining portfolio, integrate merchant APIs, and maintain zero downtime redemptions, all while competitors like USDC gain ground with bank-grade governance. Any failure in one pillar when it comes to audit, tech, or regulation would be exploited by rivals and arbitrage desks. In short, I think Tether's runway is very clear, but the margin for operational error is thin and there. When it comes to the investment and the strategic implications here, we need to first fully recognize that the fulcrum has shifted. The ballast that truly underwrites USDT is no longer the dollar so much as Tether's 9-figure Bitcoin stack, over 100,000 BTC. If the company continues to buy 10 to 12,000 Bitcoin per quarter from their coupon income, a peg flip then becomes path dependent rather than some hypothetical. For investors, the trade is simple. Accumulate both the asset, BTC, and the rail, USDT, so your long whichever unit becomes the reference standard. Second, you should probably watch the yield compression trade as well, because by holding $127 billion in T-bills, which is the 18th largest position worldwide, Tether is one of the bond market's biggest marginal buyers. Each new treasury auction it hoovers up nudges front-end yields lower, which shrinks the real carry for everyone else, while leaving Tether's after coupon profits intact. Owning short duration bills or USDT itself becomes a backdoor bet on this liquidity loop. Third, corporate treasurers now have a playbook. They can park their working capital in USDT, earning near risk-free money fund yields, then at the board's discretion toggle into Bitcoin via Tether's coming dual redemption lane. That's hypothetical, I'm just saying it is possible. That would turn a sleepy cash buffer into an option on digital gold with zero operational friction. And then macro allocators could then internalize this scale. Remember, already commands 58% of a $300 billion stablecoin market and is growing faster than the base itself. JP Morgan's desk sees up to $1.4 trillion of new dollar demand by 2027, driven by stablecoins, with Tether poised to capture the lion's share. A rail that size, backed by a hard asset reserve, could crowd sovereign paper and reprice FX liquidity worldwide. This is the macro takeaway. The hierarchy of money is redrafting in real time. A stateless, programmatic central bank that settles at light speed, earns billions of dollars in free cash flow, and stockpiles the scarcest collateral on Earth is no longer a crypto curiosity, it is a macro variable. Position your portfolios, your treasury policies, and even policy models accordingly, because the next liquidity cycle may clear not through the Fed, but through a green branded token darting across public blockchains. Tether's kind of a big deal, folks, just saying. My name is Adam Livingston. I am the Bitcoin Wizard. I hope you like this content. If you did, please like this video and subscribe to the channel. I like to spread the orange gospel to the masses, and I need your help to do it. It will really help the algorithm, so thank you. Have a terrific day. Don't party too hard. Class dismissed. Once again, a very special thanks to Horizon for sponsoring this video. Most people do not realize this, but on average, 60% of American homeowners' net worth is locked up in their primary residence. And with home prices more inflated than ever, Americans now sit on a combined $35 trillion in home equity. Now there's a way to unlock that trapped capital and put it to work in Bitcoin. Horizon helps homeowners unlock a portion of their home equity to buy Bitcoin. It is not a loan, so there are no new monthly payments. You keep living in your home as usual. Later, when you sell, refinance, or choose to settle early, Horizon's provider takes an agreed share of